Okay, I am going to start, and if anyone jumps on late, they might just miss the overview, so it'll be fine. Thank you so much, and congratulations for joining us today for the first part of Financial Mastery. If you saw any of my videos sort of leading up to the event or promoting the event, I talked a little bit about how today will be more of a beginner sort of portion, and then the next step, we're going to be getting a little deeper in. And you need to know this part to do the next part. So the next call is in March. We do one every month, live, free. And a lot of people ask us why we do so much for free. We do a lot of free content, and now we're doing these monthly live calls for free. And it's really simple. I got into this business because I really wanted to change the world for business owners. And we think it's really sad that 96% of all businesses fail in 10 years. We're trying to reverse that statistic. So this is just our contribution. We know this stuff works, so we really hope that you implement this stuff that you learn on today's call. So I'm just going to give you a bit of an overview of what we're going to talk about today. First, we're going to talk about the dangers of not knowing your numbers. So I see it so often in businesses that are struggling. People don't have enough cash flow, or they're not making the profit they thought they would make when they got into business. Or with new businesses, they're not breaking even as fast as they thought they would, and they don't know why. And most of the time, those people aren't looking at their financials often enough, and they're not looking at them in the right way. So they're kind of oblivious to what the situation is. So we'll talk a little bit about the negative impacts of that. Then we will talk about the income statement. It's the main financial statement that we will use in our projections and in our monthly analysis, and it's absolutely imperative that you understand how to read your income statement. Profit margins. So you probably know what profit is, but you probably haven't looked at profit in the way that we're going to talk about it. So I hope to give you some new insights there. Then we'll talk about expenses and what the differences are. There are different ways to classify expenses and different ways to separate them out, sort of be more specific, that will really make a difference for you. And we'll go over that. And then we'll talk about gross and net profit and the difference there, how to improve them both, and looking at numbers differently. So we'll get into a couple different ways that I like to analyze financial statements with my clients, and you guys can take that and use it with your statements. So if you guys have an income statement handy of yours, I would just have it handy. Like if you have it printed out, you can write on it. If not, you have it on your screen or whatever, just so you can reference it when I'm talking. This will really land probably a lot better for you. So when you don't understand your financials, where is back one? Yeah, there we go. So these are just some of the things that I've heard from my one-on-one clients, and I'm sure that you probably have your own negative impact to add here. And I'm a pretty positive person. I like to focus on, what we can do, the good things that are going on, and focus on, hope and the future and things improving. But sometimes when we don't really look at the negative impact of not changing, or if we don't look at the negative impact of staying the same, we don't change. So I do want you to really think about these things, and also think about anything additional that might be happening because you're not fully understanding your financials. So cash flow struggles. This is the number one biggest problem with people who aren't really knowledgeable about their financials. They don't know if they're going to have enough money to pay their bills. A lot of people don't know if they're going to have enough money to make payroll. A lot of people don't know if they'll be maxing out their line of credit next month. They don't know if they can hire a new person. Like, it's just, cash flow is probably it's definitely the number one complaint that I hear from people that don't understand their financials. So that's one big thing, never knowing if you'll have enough money. And that is stressful. Money is the number one stress. So that sucks. Also, unnecessary feelings of hopelessness, stress, and anxiety. So this isn't just you feeling bad, though. This when you feel bad and you feel stressed or you feel overwhelmed about your financials, I guarantee it's affecting those people around you, those people that you love, those people that are important to you. So whether you have kids or a husband or wife or a business partner, even your friends, when you're feeling hopeless and stressed out about cash flow in your business, you're just not showing up the same way for the people that you love. So it's not just you that it affects, it's the people you love as well. Last, I find it really impossible for people to set goals when they don't have an accurate picture of what their financials look like now. So if you don't know how much cash you'll have in the bank next month, or if you can't predict or project your financials for the next year, you really are, your hands are sort of tied in terms of setting goals or coming up with strategic objectives for your company. You need to know where you're at. I usually say that it's like trying to lose weight without ever getting on the scale. You'll never know if you lose weight if you never measure, right? So maybe just take a moment to jot down anything else that comes to mind, anything negative, anything that just sucks, that's bothering you, that's hard, that is related to money in your business. Now, when you're finished with that, if you can pull up your income statement or get out your income statement and follow along, this will be really helpful for you to have yours handy. If you don't, you can just look at this example that Tara found for us. So the first thing at the very top, and for some of you this might be a review or you might think, oh, I know this already, but just stay with me for another 20 minutes, 30 minutes, and I think you'll learn some different ways to look at the statement. So I am going to go over what each row is on the statement because some people don't even know that. So that's where we're going to start. Your revenue, so your income. So this is an income statement for one whole year. You can actually print an income statement for any period of time. And the income statement is also sometimes called a profit and loss statement. So profit and loss statement, income statement, same thing, okay? Obviously, it's going to show your income, it's in the name. And in the best cases, we have all your income split out. So we'll see sales from product A, sales from product B, or sales from service C. You know, you want to see if you're, let's say that you're a spa. We want to see how much revenue comes from your float tanks. We want to see how much revenue comes from massage. We want to see how much revenue comes from facials. And we'll get into why in a few minutes here. We're going to talk about gross profit for each type of income, but just know that for now. If you're looking at your income statement and you only have one number under sales, but you have more than one product or service, it's really worth having a conversation with your bookkeeper and having them split out your income and your revenue into sub-accounts. So you can have as many or as few sub-accounts as you want in any of these accounts. But I recommend if it's got a different profit margin, which means we'll get into that on the next slide. But if it's a different product or service, I highly recommend having a look at splitting out that income. Now, if you've got like thousands of different products, don't go doing thousands of sub-accounts. We want to do like categories in that case, okay? So on this income statement on our slide here, we've just got the sales revenue. And I would like to break that down. If you have more than one type of thing that you sell, break that down into the different categories, okay? Next, we have cost of goods sold. So cost of goods sold, or COGS, the acronym, that is the cost of making the sale. So any variable expenses that go up or down with sales that you have to incur to do the sale are cost of goods sold. So I know that was kind of a mouthful. If you have to, let's say, buy product and then you sell it to a client, the cost of buying that product would definitely go under cost of goods sold. If you have to pay an employee to provide a service for a client, their wages for that period of time that they were providing the service should go under cost of goods sold. Now, if you have an admin position on payroll, or if you have an employee who usually provides service but is not productive for a certain amount of time, that payroll goes down in overhead expenses. So we'll get to that, but basically cost of goods sold it includes all the expenses that you have to incur to make the sale, and they vary with sales. So if you sell more, the cost of goods sold will increase. So a good example of that, like I said, was the wages of the people who are providing the product or service, the products that you have to buy to resell, and it can even include things like commission fees or credit card fees, because those go up with the transactions and the sales, right? Okay, so hopefully you're still with me. Really quick, we've got the income, the cost of goods sold, and now we're going to talk about gross profit. So gross profit is your revenue minus your cost of goods sold. Many of you might be looking at an income statement or a profit and loss statement that does not have any COGS, so your revenue and your gross profit are the same number. Now, if you truly don't have any cost of goods sold, like if you are a service provider and you don't have to buy any product and resell it, or if you're a professional or a consultant and you don't sell anything but services, so all you really have to do is have a person there to deliver the service. Even in that case, their wage should be under cost of goods sold. But if you don't have cost of goods sold, you can't figure out gross profit. So you do want to talk to your accountant or your bookkeeper about this. If you've got items down in your overhead expenses that vary with sales, they need to go up to COGS so that you can figure out your gross profit. And a lot of people say, why does that matter? Like, why does it matter if the expense is down there or up there? And I always just tell them that when we can look at the gross profit, especially for different types of revenue, then we have more levers in the business to pull. And all we ever do when we improve a business or make a business more profitable is we just do more of what works and we do less of what doesn't work. So in this case, it doesn't work to have all your expenses lumped down under overhead expenses when some of them actually vary with sales, because we need to know your gross profit, and ideally we need to know your gross profit on each different type of product or service. So the way you figure out gross profit is, again, your revenue minus your COGS equals your gross profit. And you want to do that for each category or each type of revenue. So if you sell product A and product B, you want to know the revenue from product A and you want to know the COGS from product A, because then you can do revenue from product A minus COGS from product A equals gross profit for product A. And this is probably the biggest, most impactful insight that most people get when they haven't been splitting out their accounts. They haven't really taken the time to look at the actual numbers of what revenue that product brings in and what expenses that product incurs, and therefore what the gross profit is. Because a lot of people assume they have, 2 or 3 products and they assume they know that, well, this one makes us more money because it costs us less to buy. But if they don't have their wages up in cost of goods sold and they don't have them split out per category, they actually don't know what their gross profit margin is. And when people actually calculate this out and they realize sometimes that the product that they spend 90% of their time and energy selling and producing is actually a lower profit margin item, they're just like, oh my gosh, I can't believe I've been doing this for so long. But you can't tell until you break those out. So I know that might be a little confusing. Make sure if you guys have any questions at the end, you can ask them. But let me get through the rest of these slides and I think it will really land for you. Also, as I'm talking about the formulas, there's only really 2 formulas, so don't get stressed out. If you write them down and use your numbers on your income statement to do them, I find that it's a lot easier to really learn them and they stick. So again, what we talked about was gross profit equals income minus COGS. So underneath gross profit, we have our overhead expenses. And these are fixed expenses. They don't change with sales. So whether you sell 100,000 or 50,000, these overhead expenses will stay the same each month. So it's your accounting fees, advertising, insurance, software, internet, admin payroll. So any wages that you have to pay to somebody whose wages don't change with sales, like somebody who gets paid no matter what the business is doing, those go down in overhead. And so you can see probably by your income statement or ours here that net profit equals gross profit minus overhead expenses. If you don't have cost of goods or gross profit on your spreadsheet or on your income statement, then you would just do your total revenue minus your total expenses equals net profit. I think, yeah. Well, I just did that slide without skipping to it, so we're going to skip that one. Splitting out accounts. Okay, great. So I might flip back to this income statement for a second here. Yeah, I'll have you go back to the income statement, please. Thank you. Yes, thank you. Okay, so we talked about splitting out your revenue into sub-accounts. So if we have 3 products, we want to see 3 different lines under revenue. We talked about splitting your COGS out into 3 different costs for the 3 different products. But you also want to really get specific with your overhead expenses. So if you are the kind of person who just drops off your receipts and your bookkeeper or your accountant takes care of it, and then you look at your neat little report and you don't investigate, there may be some things lumped into like miscellaneous expenses or office expenses, or even wages. And without drilling down and looking at what adds up to those numbers, you could be missing something that would be really easy to save money on. So for example, sometimes I work with family-run businesses, and sometimes one person in the family will be running the finances and another will be running the actual operations of the business. And if the person who's actually in the business every day doing the operational management doesn't look at these numbers every month and doesn't drill down to find out what added up to these numbers, there's a real disconnect. And there's often bills that are happening, like, what's a good example? Like a credit card. If we buy a software program and we have to pay every month, sorry, just one sec. So for example, you might buy a software program and it's like a monthly fee on your credit card. And because one person is doing the finances and one person's running the business, the person doing the finances paying the bills doesn't think twice about it. But the person who's running the business, if they saw that fee, they'd say, we haven't used that software in 6 months. Why are we still paying for that? So that's just a small example, but there are some huge savings to be had there when you get more specific and drill down on your expenses. So if you use QuickBooks Online, which we use, and it's very user-friendly, I really like it. I like it because it's cloud-based and you can log in anytime and look at your reports. When you look at a report like this one we've got up on the screen here, if we see a $25,000 advertising cost, we click on that and it will sort of generate a list of transactions, and it will show every amount and every person we paid and the date that went into the advertising cost. So keep in mind this income statement we have up here is for 1 year. So when we drill down into there, we'd probably find, monthly bills that were for Facebook ads or Google ads or radio or whatever these people were doing with their advertising money. And we would be able to check each one and make sure that it was actually something we wanted to pay for. So I should have actually added that on here. We should add that on here for next time, but it's super important that the person running the business, the day-to-day operations, gets involved in the financials every month. There are just so many things that can be missed when somebody's handling the finances and they're not in the business. Also, miscellaneous, how scary is that? That you have a miscellaneous amount on there for $5,000. Like, what does that even mean? So if your bookkeeper is putting expenses into a miscellaneous category, you need to go in there and find out what that is and then ask them to put it in a different account so that you can keep track of it, okay? In the next live call, we're going to build an actual financial plan for the year, and we'll have goals for every month. And then we'll look at an income statement to see if we hit our goals. And that would be an example. We're not going to budget for miscellaneous. We'll have a zero budget for miscellaneous. So if you have $5,000 expense show up in miscellaneous, that should be concerning to you. Wages as well. So a lot of people, even though they might have employees like salespeople who are paid commission, or a dentist who gets paid commission, or what other kind of people get paid like that? Professionals, anybody who's basically able to be billable or not billable. Like if they're billable, they're charging a client. If they're not billable, they're doing something in the office, right? Anybody who's billable or who has to be paid for their time so that we can sell the service, their wages need to go up into COGS, because that is a cost of doing the sale. It's a cost of goods sold. If you have to pay, let's say you're a hairdresser that works at your salon to do the haircut, you have to put what you paid her up in cost of goods sold so we can get an accurate look at gross profit. And again, people say, why do we need to calculate gross profit per sub account or per type of revenue? And it's because there are some surprises hiding in there for you, and there are some real insights in there. Once you see, let's say that maybe one of your services is twice as profitable as the other, you could, depending on the market and the competitive landscape in your area, you might decide not to sell that product or service anymore. Or you might decide to raise your prices, or you might decide to get more efficient. But these numbers that you're going to look at every month, and the budget that we'll build next month with all your financial goals, they're the only two things you need to look at to determine what to work on next in your business. That's why this is so powerful. And that's why I am so passionate about making people look at their numbers. I think it's just insane for people not to look at their numbers. You look at your numbers every month to see, did I hit my revenue goal? Yes? Great. What did I do really well? Make that a procedure and keep doing it. If you didn't hit your revenue goal, we want to go look at our marketing, look at our sales process, look at our conversion process. What percentage of people that are leads are turning into customers? If you can increase that, it's free and we can increase our sales. Then we look at the expenses. If we budgeted $100 a month for insurance, but suddenly we're paying $700 a month in insurance, we need to go and investigate that. Okay. We can go on to, yes, this one. Thank you. Okay, so gross and net profit, measuring and improving these. Okay, so we talked about the formula for gross profit. There it is. So if you haven't written that down yet, write it down now. So gross profit is your income minus your cost of goods. And I'm sure you noticed, but income and revenue are interchangeable. And also net profit and net income are the same thing as well. So once you measure your gross profit properly on the different categories or the different types of products or services, then you're empowered and you have the ability to, like I said, either sell more of the higher profit margin things, sell less of the lower profit margin things, raise prices, or decrease your expenses somehow. We had a business that we worked with, and I think it took them 2 months to get their budget fully broken out the way that they wanted it. And then they realized that they had about half of their space filled with items that were their lowest profit margin. So before they broke things out and looked at income from this product, cost from this product, they had no idea. And they do have a lot of products, so it would be really hard for them to sort of know that in their head. But be careful if you're somebody that's saying, I don't need to do this. I know which products are the most profitable or which services are the most profitable. You really need to do the work of laying out the sales and then the cost of anybody you had to pay to do that and the cost of any product that you had to buy to do it. Even if you give, let's say you give gift bags with every purchase or something, you have to include those because they're part of doing the sale, right? And also, if you're not tracking your employees' time, this is a huge one. Can we add that too? Tracking your employees' time. So you might have somebody who, let's say in a cafe, half the time they're waitressing, but the other half they're cleaning, stocking, that sort of thing. And you're just paying them a wage. If you don't calculate their wage for half of the time up in COGS, you actually don't know if your cafe is profitable or not. And I've seen this in so many businesses because it's just easier to lump all the payroll into payroll, right? It's kind of a pain to move the payroll cost up into COGS, just the relevant ones, but it's so worth it because I've seen so many business owners, especially in professional services where the profit margins tend to be fairly high, they just assume things are going really well. But when they broke down the cost, including all the wages of people's time that went into dealing with a client, they were really surprised at a lot of them. And this includes, like, if you have an admin assistant or a receptionist that, you know, has her part in a procedure where you service a client, that should be counted too. If an hour of her time has to go into making that sale, that should be counted as well. It's not just the salesperson, it's anybody's salaries who are involved in making that sale. So I hope you're tracking your employees' time. If you're not, you should really start. There's a lot of amazing insights that can come from that. And you don't have to get them to write down every little thing every 2 minutes. Hopefully you have some software that really helps you track time, or at least have them keep a time diary. So once a month or every second month, so that you can see what % of their time is generally being allocated to each thing that they do. So hard not to go off on a tangent about that, because there's so much with employee efficiency that I want to talk about. We will do another presentation on that. But yes, start there. Track your employees' time, definitely. Net profit. So net profit is your gross profit minus your total overhead expenses. So obviously we want to increase our gross profit so that we have more than enough to cover our overhead expenses, so we have some net profit left at the end of the month. So there are a couple ways we can increase net profit. Either we increase our revenue and our gross profit, or we decrease our overhead expenses. Now, a lot of people, when they come to us, they say, well, I've already decreased expenses as much as I can. There's nothing else I can cut. But when they start to look at their financials in a different way, and they split things out and they start to allocate things up to COGS, because they're actually COGS, they're not overhead, they start to drill down on those numbers on their income statement and find out what added up to that number. They often find a lot more things that they can stop spending money on. But more than that, it's internal efficiency that I find makes the biggest difference for net profit. And it doesn't have to be like, you don't have to hire, Lean Six Sigma team to come in and just go crazy on your business. You just need to look at your procedures. So probably the most boring thing that we teach is procedures. It's worse than numbers. People hate working on procedures. It's often something we really have to push our clients to do, but it's so worth it, because the very writing of a procedure tells you how efficient or inefficient your team is being. So, and you don't have to write the procedure yourself, get the team to write them for you. But let's say that you go to your sales team and you ask them to write out the procedure that they go through for converting a lead into a client. And they write out, okay, step 1, I do this, step 2, I do this, step 3, I do this. Okay, great. What is our conversion rate? How many leads turn into clients? Let's say it's 50%. You review the procedure they wrote for you, and you realize that since you've started the company, it's grown quite a bit, and the salespeople are no longer doing things the way that you had done in the past, so it's not working as well. So what you want to do is just help them edit the procedure and say, actually, I'd like you to do this at this step, and I'd like to make sure that you read this script to the customer, or I'd like to make sure that you follow up 5 or 6 times, not once, and you increase your conversion of leads, and you don't spend any more money on marketing. In fact, you can decrease your marketing spend, and you increase your revenue. So that's just one off the top of my head example, but there are so many areas in your business where if you just sat with the team and said, let's write out the procedure for this, you would notice that either the way that they're talking or the way they're handling the client or something that they're doing or not doing, if you could just tweak that a little bit, it would increase your profit. And again, you can increase your profit by either decreasing expenses or increasing your revenue. There's lots of ways to do that. Okay, this one I wish I could write. So this one you guys should write as your, you know what I might write and hold it up? No, then it would be backwards. I'm just going to talk through this. I learned by writing and reading, so this is a struggle for me. I got to get a need to be able to write on the next one. So I want you to start looking at your numbers differently. So a lot of times we look at an income statement and we just see, let's say we made $5,000 profit. If you just look at that month compared to another month, let's say the next month was $6,000 profit, that doesn't really tell you anything. It does tell you you made more profit, but it doesn't tell you, it's not comparing apples to apples. So what we like to do is take your net profit and your gross profit as a percentage of revenue. And that's how you figure out your profit margin. Okay, so we need to take, let's say, gross profit. Let's go back to the income statement here. Slide 4, please. Okay, so for example, on here, we would take our gross profit, $350,000, and my face is covering the revenue. Is it $500,000? Total? Yeah. Okay, so we'll take 350,000 and divide it by 500,000. Now I need a calculator. I'm sorry. So, or do this on your income statement because it'll make it way more real for you. So gross profit divided by total revenue. So 350 divided by 500. Is 70% or 0.70. Okay, so we now know that for this period of time, our gross profit margin was 70%. That's pretty good, depending on your industry, right? And then we're going to take our net income, 91,500, divided by our revenue, 500,000. And so that is 18.3%. That's really good net profit margin too, depending on your industry. So now you know that for this period of time, we had a 70% gross profit margin and an 18.3% net profit margin. Now for the next period that you want to compare it to, you can take your gross profit and divide it by your revenue and your net profit and divide it by your revenue. So you can see the percentage of revenue that your gross and net profit are. This might sound a little weird or you might not understand the point yet, but if you do it in your business and you take, let's say, January, February, March, April, take all 12 months of last year and you put percentages to your gross profit and your net profit for every month, you'll probably see fluctuations, and that should concern you. Whenever you had a really good month, that means for your gross profit, that means you spent less on COGS and you had more revenue, right? If you had a really bad month, you spent a lot on COGS and didn't bring in enough revenue. So sometimes in a lot of industries, you'll buy a bunch of stuff in one month because it's a good price if you buy a lot of it. And then in the following months, you won't buy as much. So your gross profit margin will be down and then up, up, up. But you just want to keep track of that year to date. So after January, February, and March, is it leveling out? Does it make sense? Why would one month be higher than the other? And taking these two numbers as a percentage of revenue really gives you a comparable number. Because like I said, if you do, $1 million one month and 500,000 the next, and you look at the profit, the gross profit and net profit on that, it's really hard to compare apples to apples. So take them as a percentage of revenue. And you can do this with your payroll. Take your payroll expense divided by revenue and look at that percentage. You can do that with advertising. Yeah, it's really hard to stay on one topic, and I want to talk about advertising now. But advertising, for example, let's say that you want to spend 1% of your total revenue on advertising this year. You just take your total revenue, multiply it by 0.01, and that's your budget for advertising for the whole year. And then every month you have to watch that. What is your advertising as a percentage of your revenue? If it's higher than that 1%, we need to work on that. We need to look at that. Is the advertising working? Because if it was, the revenue would be up and the advertising cost would be what we predicted, right? Okay, I hope that makes sense. You can probably leave it on that slide. Yeah, okay, the second point I was going to say when you're looking at these numbers differently is compare the statement and the numbers in the statement to different time periods. So like I said a few minutes ago, if we want to look at each month in the year, look at the revenue that came in each month. Why is it different? Look at the COGS in each month. Why is that different? And then gross profit, which is the inverse of your COGS, that will be different too. And you want to find out why. You might have, a slower season. You might have a big buying season, but you want to know why. So when you look at your income statements, you want to be able to explain those differences. And compare the percentages to other periods as well, not just the numbers. And the last thing that I wanted to mention about looking at your numbers differently, we can maybe go to that slide 8 now. Looking at numbers differently. Yeah, there you go, thank you. A lot of people ask me when they come in, well, what's good for my industry or what's standard for my industry? And usually I encourage people not to look for those numbers because I find that it really limits them. Because let's say they're in an engineering company and they find the industry standard profit margin and they're like, oh, we're beating it, great, we're good. Then they could just start coasting on that, right? We don't want you to do that. We want you to basically, and we'll talk about this in the next call, but we want you to create a projection for 12 months and look at the net profit at the end of that year and say, yes, that net profit is worth all the hard work, it's worth all the struggle, it's worth all the risk that you take in being a business owner, and that number makes me happy. So I encourage you to always look to do better than industry standard if you have already looked at that number. But more than that, I want you to make that number something that makes you happy. And that's how we build a budget. And that's what we're going to get into on our next call, is building a budget and then checking your numbers monthly against your budget. So I know that was a lot of information, but believe it or not, that was less than half of the live call that we planned to do. We split it up into 2 parts. So I really hope that was helpful. If anybody has any questions, you can ask them now. Where are they going to show up?
So just at the bottom of your screen, you'll see a Q&A box. So just click on that and you can type in your question and hit send.
So on the bottom of your screen there, guys, I'm not sure if you could hear Tara, but you should see a Q&A box there. And then just type it in there and hit send and your questions will come to us. And then we'll go to the last slide too. Thank you. So our next live call, like I said, they're always free. We're going to do this every month. We're going to talk about building a plan and tracking monthly. So we'll actually set up some numbers for revenue, COGS, gross profit, overhead expenses, and net profit. We want to lay it all out for the next year. And then every month, we're going to teach you how to track your actual numbers against your goal numbers. And that is the most powerful thing, the very first thing that we teach all of our one-on-one clients. And it makes a massive impact on your net profit. So hope you guys will join us in the next call. Do we have any questions? We have a question, but we can't click on it. Oh, okay. How often should I look at my income statement? Okay, so great question. Every month you should be looking at your income statement or your profit and loss. Some of my clients actually look at it weekly, but that means that you have to get your expenses and your income entered into your bookkeeping software weekly. Okay. Do my own or hire a bookkeeper? Okay, so the other question is, should I do my own bookkeeping or should I hire out a bookkeeper? And I always recommend that you hire a bookkeeper because they're just way better at bookkeeping than you are probably. And also it's probably not your most valuable activity. So if your most valuable activity in your business is getting new clients, doing sales, delivering some of the services that you charge for, you want to give your bookkeeping, give all your expenses and your sales numbers just to a bookkeeper or an accountant who knows what they're doing so that you can get your reconciled, perfect, accurate statements every month. If you don't, you run the risk of not having an accurate picture of your numbers until the end of the year when you go and get your taxes done. And people who only get their taxes done once a year and don't know their numbers till the end of the year do not have good numbers. If you have good numbers and you're only getting your accounting done once a year, oh my gosh, you could have amazing numbers if you did it every month. So yeah, you should check your numbers every month, and I recommend hiring out your bookkeeping and accounting. Unless that's something you really, really love to do and you have other people doing the other valuable activities in your company and you're well trained, then that's okay too, because the whole point of this is for you to enjoy your business, and if you like doing that, then that's something you can look at if you're good at it. Is that it? Yeah, okay. Thank you guys so much for joining us, and check Facebook for the post, but it's March 12th, Tuesday, again at 5 o'clock Mountain Standard Time. So I really hope that helped, and go implement that stuff because that's the only way it works.